This week, we're going to talk U.S. and Canada cattle and sheep. We'll talk broilers, and we're going to touch on tariffs. Welcome to the Weekly Livestock Market update on Brownfield. I'm your host, Meghan Grebner. With us this week is ag economist Josh Maples with Mississippi State University. Welcome to officially March Madness, Josh.
Hey, Megan, is that what this is? It feels like it's been madness for a little while.
Well, I think
Travel season.
The tariff season that we're in right now, it might be a little bit more mad than it is any other time of the year.
Yeah, well, I was just referring to all the meetings and the travel. It's been fantastic to see everybody. I made a comment last week. I think last year felt it, but this year feels it even more. We are fully back into full-blown in-person meetings. It feels like 2019 again.
Well, it's good to be seen, right? And it's always nice to be on the road, but it's great to come home.
For sure.
All right, we're going to get into some of that report conversation coming up in a little bit, but let's recap what happened this week in the markets.
Yeah, so live steer prices ended the week 196.90 per hundredweight for the 5 market average. And Megan, this was down 75 cents from a week ago, which is going to contrast with the futures discussion. So April live cattle futures up sharply, back over $2 per pound or $200 per hundredweight. This about $7.70 higher per hundred than a week ago. So big movements there in live cattle futures. Same for feeder cattle futures. We'll talk about it a little bit later, but a lot of movement in feeder cattle. The March contract was up 260 on the week to 277.58. Some of this, tied to what we saw in the cutout. Choice box beef cutout was at 314 and 7 cents at the end of the week. This was up about $1, a little over $1 from the week before. On the hog side, cash hogs 33 cents higher to $87.48 per hundredweight, and lean hog futures were up $3.55 per hundredweight to $87.23 on the week. We'll switch over to the pork cutout real quick. Pork cutout down 24 cents from a week ago to $97.78 this week.
And we're going to dig into those a little bit more. But first, let's talk what we saw in the terms of weekly slaughter this week.
Yeah, so weekly slaughter up about 2% on the week on the cattle side, so 578,000 head. It's up about 12,000 head from where we were a week ago. If you look back to a year ago, still seeing some of those lower than year ago numbers that we've talked about a few weeks here, down 6,000 head from the same week a year ago. On the hog side, also down 120,000 head from a week ago. To 2.418 million head of hogs slaughtered. And this was down about 22,000 head compared to where we were in same week of 2024.
Are you assuming some of this, or would your guess be some of this maybe pullback in slaughter numbers is one, availability, but also kind of some seasonality happening in the ebbs and flows of markets?
Oh, yeah, I think it's definitely both. On the cattle side, we've got some, we're going to see this. We're going to see some tighter numbers, but we're also seeing these seasonal patterns as we move throughout the year. So, yeah, I think it's both, and I think it's also reacting to what's going on with market prices as well.
So let's talk a little bit more about that, Josh. There's been a lot of movement and some volatility in markets. I'm sure a tariff conversation early in the week doesn't help, and really just kind of how that's been rolling out this week. But is this a good time to have a little bit of a reminder of a refresh on that risk management and protecting your investments long term?
So Megan, I'll use a contract that'll hit home to a lot of cattle producers, especially stocker producers. That look towards that May feeder cattle contract. So if you look at just this week, and really just since Tuesday of this week, that contract was trading near 265 at one point on Tuesday. And then by Friday, it was trading up near 279. That's a $14 swing in 4 days. Now these prices are high, and I think Kenny, I don't know if he talked about it on here, but Kenny Burdine has talked about the need for risk management strategy even when prices are high. And it's absolutely true. Even when prices are high, you can have these really big swings. And if you're caught selling at a time when you're at the wrong end of a swing, then you're in trouble, or at least you're leaving money on the table. So yes, to answer your question, this is absolutely a time to think about risk management. And I talk about this at every meeting right now. It is way more fun to do risk management when we're at high price levels. And so we have high price levels, but we have volatility. There is significant volatility in these markets. The tariff discussion is obviously a big part of that. And it's not just tariffs on cattle or beef or products like that. It's also tariffs on all the other things that then tie into our cattle and hog markets as well. So just uncertainty in the markets is leading to volatility. It's a really good year to think about some price risk management strategies for your operation.
Josh, we talk so much on the news side, and I've been with reporters and farmers at Commodity Classic this past week in Denver, so much about how the news cycle, with some of these announcements and some of the executive orders and the tariff conversations, aren't lasting a news cycle. How much does that contribute to this one added volatility? But does that make it even more important to be proactive in terms of risk management and in all aspects of your operation?
I think it'll help you sleep better. That's why there's a lot to be said of that. And I talk to producers, Megan, who tell me that hey, one of the big benefits from doing price risk management is really just that ease of mind. They like to watch the markets every day. They like to keep track of the news that affects their operations, and protecting yourself from on the price side, doing something, whether it's futures, options, LRP, livestock risk protection is a good tool right now for cow calf producers and stocker producers. It kind of, I don't want to say it insulates you from these news cycles that you're talking about, but things are moving really quick right now. And, you hear something one day and then it may be different a couple of days later. We've seen that on the tariff discussion, right? I mean, we've seen tariffs announced and then a day later backed off, or 2 days later backed off, or announced and then lessened. It's hard to track. And that is absolutely one of the reasons for the volatility that we are seeing across futures markets of all kinds.
Nothing likes uncertainty, right?
Yeah. I mean, it's, markets, and it's, it's not just the reason that we see the prices go down. It's the reason that we see prices swing up. It's the volatility goes both ways. But for producers, again, I think it's a really, really good time to consider price risk management for a lot of different reasons. And you're locking in some high prices. So, it's not like it's not like you're trying to lock in at your break even level. There's opportunities here to protect yourself at some really strong levels on the cattle side.
How much also weather, thinking about this? I mean, we've talked about this a lot in recent weeks, setting up for a La Nina, which is great for our part of the world, right? To get moisture. But that's not great when we're thinking about cow-calf country or corn and soybean acres, in knowing that that could be a challenge that producers face long-term in 2025 as well.
Yeah, that's another thing that's leading into this. I'm glad you mentioned corn and soybeans. 'Cause that obviously cattle prices, or especially feeder cattle prices, really connected to corn prices. If you look at the nearby corn contract, we've seen the nearby contract shift pretty significantly over the last couple of weeks. If you just look at, say, the March contract, or let's look at the May contract. The May corn contract on feeder, or CME futures contract for corn was at over $5 on February 21st, and it was at mid 450s, or about 459 on the middle of this week. So we've seen a lot of movements, not just in the cattle and hog space, but also in the feedstuff space, and weather absolutely ties into that. The tariff discussion absolutely ties into that. What are producers going to plant? or we're going to see more corn. All of this spills over into the markets that we're talking about. And so it's a really, it's always an uncertain time of year because there's nothing in the ground yet. But it's even more so this year.
And we have prospective plantings coming up at the end of the month, so that gives us even more to digest market-wise as we're thinking about the upcoming year.
Absolutely.
All right, so we're digging into the vaults this week, and we're going to take a look at U.S. and Canada cattle and sheep report from the USDA. When you take a look at a report like this, what makes it so important into thinking about the grand picture of what's happening market and availability wise?
Yeah, so we know the U.S. numbers pretty well. We've talked about those. The U.S. cattle inventory report that came out a couple of weeks back, or it's been longer than that now, right? But I thought this one was interesting just to kind of look at what's going on with the cattle inventory numbers in Canada. And so USDA basically puts together their numbers from the cattle inventory report here with a Statistics Canada data. And so this one comes out once a year. It came out Wednesday this week. It includes estimates of all cattle and calves as of January 1. Meghan, some stuff that kind of jumped out to me. So total cattle and calves in Canada on January 1 was at 10.94 million head, so just under 11 million head. Of course, if you compare this to U.S., we're at 86 million, 87 million head, so some differences there. It was a 1% decline in Canada, similar to what we saw here in the U.S., but I really like to look at the beef cow numbers and the heifer retention numbers. So out of those 11 million head in Canada, it included a 3.4 million beef cows, 960,000 milk cows. If you look at that beef cow number in particular, it's down about 330,000 head since 2021. So seeing some declines in the beef cow numbers in Canada. But one thing that jumped out to me, because we've talked about it in the U.S. all the time, is that they did hold back a few more heifers. So heifers held back for beef cow replacement in Canada actually increased. It was up 1% on heifer retention from 2024 to 2025. And of course, in the U.S., that number was down 1%. So it does suggest a little bit more heifer retention on the beef side in Canada is going on so far. I'm gonna plug it real quick. Just and the depth on the sheep side, the report showed 806,000 head of sheep and lambs in Canada on January 1, and that compares to just over 5 million head of sheep and lambs in the U.S.
And we don't talk a lot of sheep and lambs, and obviously it's a different part of the country than where we're based at primarily. How does that market compare in terms of risk management or thinking about profitability for them and compared to what we do on the cattle and hog side of things?
Yeah, you're getting me out of my lane a little bit. I don't talk about sheep and lambs a lot either, but I think LRP may be a tool there. Don't quote me on that one for sure, but I know that there's always an effort there for some risk management on the sheep and lamb side, but I'm not sure exactly where that's at.
While we're talking about Canada, we had an announcement this week that restrictions on imports from the Tar Heel Smithfield plant, and getting into it, it's not all animals, but on imports going into Canada. So when we think about this tariff conversation, is there potential that we see more of these types of announcements? And how does that impact profitability on the hog sector if it's more than just awful or it's more than just a small section?
Yeah, that's what's going to be really complicated about this, Megan, in terms of trying to predict how things are going to play out. It's not as simple as just, U.S. places this percent tariff on all products and Canada then responds with this percent retaliatory tariffs on all products. It can get really specific. And the example that you're talking about, I mean, that's as specific as it gets, right? Targeting a very specific thing in a specific location. And it's going to be really hard to predict those kind of impacts. And I think that's why we're seeing as much volatility as we are because you just don't know what the reactions, not only Canada, Mexico, China, every country that is in the news right now, you don't know exactly how the response is going to be. So certainly if that expands out to other products, then it becomes a bigger deal. But that's the uncertainty that these markets are trying to absorb right now.
Not without volatility. The the poultry sector has been battling high path avian influenza. We're going to talk a little bit about that broiler hatchery report. Josh, as you take a look at these numbers and what's happening on the poultry side of things and the egg side of things, how does that, not just on the producer element, but the consumer side as well? Because we're seeing a huge impact. You have young kids, I have kids. Um, $9 a dozen for eggs, anywhere to 12 is not going to bode well long term, I would assume, for demand.
Yeah, I mean, it's been really interesting, Megan, in terms of I think we've got a really strong appetite for eggs. We've shown that, that we've continued to buy a lot of eggs even as prices have gotten really high. Now, I do think prices will moderate. There's a big seasonal pattern there. We'll see how that plays out as we head into the spring and summer months. But we've seen these markets move, certainly not this high before, but we've seen the egg prices uh, change pretty significantly within a year before. So that's going to be a really interesting thing to watch as we move into May, June, July, as things are moving seasonally. The broiler side to me is really interesting. I mean, of course, the egg side is fascinating too. Um, the broiler side is interesting. That was the report we got this week, was that broiler hatchery report, and it really kind of set the set the stage is not the right word, but it kind of reassured us of what we were kind of already seeing. If you remember back, WASD is projecting about a 1 to 1.5% increase in broiler production this year. And of course, that has implications on the beef and hog side as well. But if we look at this hatchery report, it showed broiler type eggs up nearly 1 million from a week ago. So 251 million broiler type eggs hatched last week. And this was on the chicks placed. And so 191 broiler chicks were placed into meat production. That's up about 500,000 chicks from a week ago. These are just kind of continued pieces of evidence that we're expecting larger chicken production in 2025.
Does that also, we talk about the demand resiliency for beef, but if we're seeing higher egg prices or higher beef prices, um, with an increased supply in chicken, does that start to compete more in the grocery cart if budgets are a little bit tighter?
Sure. I mean, especially on the ground beef side, is where you start to think about. But yeah, if you see ground beef prices going up and chicken prices going down, I mean, consumers make those choices at the grocery store, and so that's going to be something really interesting to watch. It's not necessarily a shift in preferences. It's people reacting. It's people reacting to the market conditions that they're seeing. So we're gonna see tighter supplies of beef. We kind of know that, and we're gonna start to see some stronger supplies of chicken. Those per capita consumption numbers are likely to shift over the next couple of years, just like they did in 2014 and 15, whenever supplies got tight. You'll hear a lot of stories about, beef demand really struggling, but, I would remind our viewers that beef demand is price and quantity. And so we may see per capita consumption of beef go down over the next couple of years because our production goes down. But if consumers are still paying a really strong price for it, you can still have really strong demand, even if per capita consumption drops off a little bit. So I think that's going to be an interesting discussion. We're already having it, but it's going to be another interesting discussion that we're going to be touching on the next couple of years as we see these tighter supplies of beef.
Josh, the flying demand numbers are out next week. What are you watching for most as you take a look at the protein side of things, but then inputs as well?
Yeah, I'm watching that beef production number. If you remember back to last year, we saw a ton of movement in that beef, the 2024 beef production estimate from the first one to the last one. There was a big swing in that estimate as we got more slaughter data in, as we got those carcass weight data in. So I'm looking towards that in this next report. Also keeping an eye on the grain prices. I think it's going to be, obviously we talked earlier, we're early in the year on that, but I always look to see what estimated corn prices are for the year, because that plays heavy into the livestock sector. Those are the two things that I look at first in the report before digging into the rest of it.
Josh, it's always great to see you.
Thanks, Megan. Have a good day. Have a good week.
You too. We'll catch up with you in a couple of weeks. To our weekly livestock market update delivered to your email box every Saturday morning, go to brownfieldagnews.com. You can also submit questions and comments. And for market updates twice daily, make sure to check out John Perkins' Market Minute. Have a great weekend. I'm Meghan Grebner for Brownfield.